Today we're going to discuss about the difference between the residential and the commercial mortgages, how the both mortgages work, what is the eligibility criteria, how the underwriting works in these, and how the interest rates decided. Residential loans are the loans which are used to purchase the 1 to 4 residential properties, main properties like primary residence. If someone is buying something to live in as a primary occupancy, that's a residential loans, and those loans are backed by two semi-government agencies, Fannie Mae and Freddie Mac. On top of it, FHA and VA is also the two agencies who are a big part of those loans. So those loans are easy loans. They check your credit, they check your income, they make sure that the debt to income ratio is up to that threshold, currently the 50% threshold, which means all your monthly obligations, including your principal, interest payment, taxes and insurance, any credit card payments you're making per month, any installments like car loans or any other installments you're paying, all that covers under the 50% threshold. The utility payments, they're not included in that. So, and the interest rates decided on those loans are long-term fixed rates, 30-year fixed. They follow the 10-year treasury or 30-year treasury bonds, and but they give you the 30-year, entire 30-year fixed. You get 5% rate fixed for all 30 years, payable in 30 years. They concern about your income. You need to make that good income. Without that, they don't have a loan for you. Simple thing. Now it goes to the commercial. Any property which are above 5 units or more, which is a multifamily, they are commercial loans. And any warehouse, retail, any kind of commercial use property, they have a commercial loan. How they work? So if you're buying something, a commercial to use, like to occupy as a business owner, you can use SBA loan there, and they look for the cash flow. So the cash flow is the main thing where all the commercial loans stand on. Either your business cash flow will fund that SBA, or if you're buying something, a commercial, not a SBA, just a regular commercial loan for your investment, they look for the cash flow of the property. What is the expected rental income the property will bring, and what is the past income? So they see all the 3 or 2 years of tax returns from the seller, how much income that property is generating, and based on that they approve the loan. So the criteria for that is, if your property makes 25% more than the debt service ratio, then they approve the loan. So it's not the fixed thing, but 1.25% is like a standard. Some people can do 1.1, some people can do under 1, so they're taking more risk they'll take. They charge you more for that, and they also charge more interest rate. When it comes to terms as compared to residential, the commercial terms are not 30-year terms. Most of the bank, if you go to, or your area credit unions or small community banks, 15 years the max they'll give you. You can get those loans up to 25 years, 20 years, 25 years easily when you go to any brokers or so, because they have so many lenders. But those loans are not fixed forever. And those loans possibly fixed for 5 years if you get lucky there, and after that either it goes to the rate of that time, or if it's a balloon loan, you gotta pay it off or get another loan at that time. I would never advise anyone to take a balloon loan, because you never know after 5 years what's gonna happen. If your credit is not that good at that time or something happened, then you have to refund that loan. How can you repay that loan? And if you're not able to do that, if you're not able to refinance it, so stay away from all the balloons. And mostly all these are adjustable loans. How they determine the interest rate there is, it's like a two-part. So it's index plus margin. So they'll follow any index like prime rate and or LIBOR. The LIBOR is little less in the rate, but that fluctuates a lot, because LIBOR is 30 days, 60 days, 90 days, 180 days. After that, it fluctuates. So whatever rate at that time, you get that rate. LIBOR currently is 5%, and if the lender's margin is 2%, then your fully indexed rate is 7%. As compared to prime rate, the prime is 8.25 today. If you add lender's margin of 1.5% to 2%, your rate is about 9.75 to 10%. But the prime rate, it only change when Fed change the rates. Like, we have those 13 meetings in a year. So if the Fed decide to keep the rate flat, there's no change on the prime. There's no change in the prime, no change on your rate. But the LIBOR fluctuates a lot. So this is how they determine the interest rate there. When it comes to SBA, the SBA is also commercial, but you got to occupy the property, or if you're getting SBA loan to acquire a property, you're a business owner. So the criteria is same. They look at the cash flow, and they also offer you the similar rates like index plus margin, either LIBOR or prime rate. As compared to residential, these loans are way different, way expensive to do it. Their closing costs are higher, their appraisal costs are higher. If there's environmental costs, that's addition to that. And also it depends upon bank to bank, because banks are lending their own mortgage, and which is not guaranteed by or purchased by any agency like residential. Fannie Mae and Freddie Mac buy those mortgages, so the banks have some kind of relief that they can unload their mortgage and get the money back. But in commercial, whatever lender lends, that's their money. SBA gave you some guarantee, but they charge you for that too. Up to 3% is a fee. If you are getting something for $1 million, the $30,000 fees goes to the SBA. So those commercial loans are also expensive to get. If you can get some of your hands on investment property in a residential criteria, which is 1 to 4 unit, so people are buying a lot of fourplexes these days, you can get a 30-year fixed rate there. This is what I will recommend anyone who are getting into the investments, duplex or fourplexes, instead of going the multifamily. Multifamily will be your next step, but it's more easier to get because you don't have to qualify for it. So if you have any loan scenario to run, bring it to us. And how we work is, if you have a commercial loan, we have our own system to check out if the loan is feasible, if there's any possibility of doing the loan. We don't throw anything on the wall, whatever stick it sticks. No, we run our own numbers. If it makes sense, then we send the loan file to the underwriter. Otherwise, tell the borrower, hey, it doesn't make any sense. You got to bring more down payment, or the property value has to be lower. So give us a call. My information is down in the description field. My name is JP Singh, and I'm a broker of JPMI. Thank you.